And welcome back. Today we're going to talk about consumer credit and personal loans. A topic that's very important for most of us because at some point we're all going to need help with loans, or if we're not, we're going to have the opportunity to help other folks, including our friends, who might have to deal with some of these situations. Today's session is supported by the material from Chapter 6 in the Madura and Gill textbook and is part of the 7-week course in personal financial planning. Consumer credit is typically defined as the personal debt that is incurred by households. In today's session, we're specifically not going to take a look at mortgage debt, and in this course we don't really consider business debt. As a general trend in Canada, you can see that consumer debt has been increasing not just over the last couple of years, but over the last few decades. Consumer debt's become very much a part of Canadian life, and as compared to business debt, has been growing at a much faster rate. You can see that in the most recent months in particular, consumer debt has been growing much faster than personal income, a trend that is very much of concern. And whether or not this is just a glitch that's happened because we're coming out of a pandemic or a new trend is something that we don't yet know about. When we talk about credit in general, it's the ability to borrow and, most importantly, the ability to repay. It's something that becomes part of our personal history. It's essentially a privilege earned that is justified through our ability to plan for use of credit and to be able to meet our obligations. Having a good credit rating is a very important asset personally, and that's something that we often hear about when we're talking about things like credit scores and some of the problems that people have had with their credit score. We have essentially 3 major credit bureaus in Canada. 2 of them deal with individuals, the third deals with principally business. Dun & Bradstreet, my old employer, was an organization that was set up over 100 years ago to deal with business credit. And in some cases, business and personal gets mixed up because so many people are small business people. For most of us, though, we only deal with the 2 consumer credit agencies. Equifax, which is probably the best known in Canada, which we can see online, provides credit scores that are used by pretty much all of the major banks and many retailers as well. And you can check, of course, your credit score by looking online. Its competitor, TransUnion, also provides online services, and so you can take a look at their website as well. They use slightly different methodologies, but essentially their products are pretty much the same. The business has evolved over past decades when companies like Equifax used to actually arrange meetings with local business people to discuss particularly problematic delinquent experiences, particular industries, particular types of clients that were problematic. Now, of course, just about everything we do becomes part of our credit record. Borrowing inquiries, individual transactions, whether you paid your bills, your utility bills on time, anything that's part of the legal record becomes part of their system of information. You may have heard of other credit rating agencies, like Borrowell, for example, and Credit Karma. Those are also a type of credit reporting system, but they actually use the information from those other sources. Borrowell uses Equifax information. Credit Karma uses the TransUnion information. Either system is based on a system of scoring. Equifax in particular uses something called the FICO score. FICO is short for Fair Isaac. Fair Isaac is an American organization that created the FICO scores, and this is something that's been evolving over time. Basically, they use the information on your credit report to determine the likelihood of being able to pay certain kinds of bills. Lenders use the FICO score to determine whether or not you're going to be a good credit risk. And they may have warning signals that are built in case your credit score falls that will encourage them to collect any kind of outstanding debts faster. Typically, we can see that the FICO score is scored between 300 and 900. Last week, the average Canadian credit score was exactly 700. So typically anything in the 700 range is good. Anything above, say, 750 is great. Anything below that would be of concern. So the score, of course, changes on an almost month-to-month basis, and we're regularly encouraged to take a look at our credit score to make sure that there's not a particular problem. Perhaps we're being misrepresented because of things like identity theft. Somebody's been using our credit and we don't know about it. And so you can monitor and make inquiries about your credit score. Legally, both of those agencies are required to provide you with your credit score on demand. In the past, they've taken that particular direction and said, well, of course we'll give the consumers that information, but they did require you to inquire in writing, and you could only inquire so many times per year. Now, if you go online, you can ask to see your credit score, and many of the banks will provide you with your credit information for free. FICO was essentially set up to identify certain scores that might be problematic. So if your score is in the 700 range, then there's probably a very low chance that you're going to be slow in paying your bills or entirely default. They're concerned about two things: delinquency, if you're slow, and defaulting, which you completely fail to pay at all. In other words, you have gone into some kind of administration or bankruptcy. So there's a 5% chance of delinquency in the 700 range. If you fall to the 500 range, there's a 60% chance you'll pay your bills slowly. In the excellent range, over 800, clearly there's almost no chance at all of delinquency. The type of information that FICO uses in order to create that score, and that Equifax in particular uses, includes things like your payment history. They have an automated system of collecting information from utility companies, from your phone company, that tells you whether or not you've paid your bill and whether you paid it on time or whether you anticipate payment by paying before the due date. You have the total amount of debt that you've incurred relative to your income is another important factor. So that's worth about 30% of the score. The length of your credit history. How long have you been using credit, and is there a history of some kind of failure? Short histories, of course, are a risk of fraud because people may have created false identities, and so a very short credit history would become a problem. Have you got a lot of short-term debt, not enough long-term debt? The credit mix might also be a factor. Have you been seeking a lot of new credit recently, including credit inquiries? You may notice if you take a look at your credit score that there's a little note in the corner that says that checking your credit score will be treated as a soft inquiry. A hard inquiry is what happens when you sign the little box at the bank when you're looking for a mortgage, and they look for that credit information. That creates a type of a warning that says this person is already trying to find more debt, and that might be a problem. So too much new credit inquiry might actually become a problem for you as well. There have, of course, been problems with the credit reporting system. As I mentioned earlier, there have been a lot of examples of people getting into trouble because someone's borrowed their identity. They borrowed their Visa card, they've run up large bill, they've got new Visa cards in in your name, and they've been using that credit card and your credit history. So it's encouraged to actually look at this, and you'll notice that if you look at the Equifax and TransUnion websites, that for a fee, they will provide an early warning system of identity theft. So for something like $5 a month, they will give you a monthly update on your credit score, let you know whether or not there's some kind of suspicious activity. We'll talk a little bit about identity theft later on in today's session. So why do we use credit at all? Of course, we do know some people are very risk averse. They would not get into debt no matter what. Well, the advantages of leverage, something we talk about quite a bit in our corporate finance course. And for some types of transactions, like buying a house, pretty much the only way to proceed is to be able to use credit. Of course, for many purchases, there is the convenience and immediacy of being able to buy something today that you might have had to save for in the past. So clearly, having the consumption opportunity today might be important to you. Perhaps your income is either most likely variable, being a problem. Insufficient is a problem that can't be fixed with credit. So if you perhaps have very large paydays in some months and very small ones in others, credit might help with that. If your pay is insufficient to meet your needs, then you have a different kind of problem that won't get solved by credit. Sometimes people use a larger loan to cover a bunch of smaller loans to consolidate debts as part of a repayment, although, as we'll see later, that also can become an issue. Consolidating debt is something that might work in certain circumstances, but not at all in others. There are a couple of types of credit behavior that we wanted to point out as being, perhaps abuses or problematic. They've got great names like pyramiding, ballooning, over-securing, loan sharks, and loan consolidation in some cases might become a problem. Pyramiding can also, in its extreme level, be described as kiting, where we're essentially using one debt to pay off another. It's a loan for a recurring purpose. In other words, we've created a type of a problem that we can't really fix in the long term, but in the short term, we can kind of compound our debts in order to make things work. We can get out of a problem this month by pushing it off into the next month. A great example of that is getting something like an 8-year loan for a car, which you can get, or even a 10-year loan for a car, driving the car for 5 years, selling it or writing it off, and then getting another loan for another 5 or 10 years while you still haven't paid off the first loan. So essentially, we're creating a rising principal amount inside the loan and just rolling over our debt and not actually looking at ever repaying it. Or perhaps with credit cards, paying off that very, very small minimum monthly payment and seeing a rising balance over time. Ballooning is basically a feature of some loans where we can make small payments during the loan and make very little payment of the principal until perhaps the end, where we make a balloon payment. So perhaps we're going to have a fully amortizing, or a loan that fully pays itself off during the period loan of, say, $88, or the alternative would be to have smaller payments during the term, and at the end we'd make a large principal payment. Of course, that assumes that somehow we're going to be able to save that principal so that we can repay it at the end. In some cases, we may be required to put up a lot of security for a relatively small loan. Lenders like collateral, and over-collateralization, over-securing basically means that you're putting up too much security for a loan, which means that collateral can't be used for another loan, and so that reduces your overall borrowing capacity, which in the long term could become a problem for you if you're going to need that actual credit. In some cases, loan consolidation might become a problem. Ultimately, you're going to have to pay off debts, and if you've collected over time a number of small debts, loan consolidation is a way of bringing them all into one place, paying off the most expensive ones. However, the average cost of borrowing across several different lines of credit, credit cards, and so on might be higher than the total amount that you were paying before. It's something that you see advertised a lot, and quite often people realize that they're in financial difficulty, and a simple solution might not be the answer. So debt advisors, credit advisors are there to help you to decide whether or not you should enter into a consolidation loan. And you need to be able to distinguish between the credit advisory services and the loan consolidation salespeople. So some of the things that we've seen already, why use credit? Well, clearly convenience, immediacy, income deficiency, and consolidating debts are going to be part of that. A couple of different types of consumer credit. Well, clearly we have the consumer loans, and we'll look at a variety of those in just a second from a variety of different sources. And then we've also got point of sale credit, like credit cards and debit cards, but especially credit cards. And we'll talk about the distinction between credit cards and charge cards. For the loans themselves, there are a number of sources. The main banks, the large banks, the Schedule 1 banks we talked about in our previous session, are clearly a source of loans, provided that you've got the credit experience and the ability to use those kind of banking services. Trust companies used to be completely separated from the banks, but now have become largely a branch of the banking system, but they're still there as another alternative. We have a number of smaller lending organizations. We'll talk a little bit more about those, and we talked about some in the previous session. You can borrow from your life insurance company using things called policy loans, where you borrow against the equity in a life insurance policy. And of course we have the credit union, the Caisse Populaire building society system as well. This chart that I got from, I think originally from Stats Canada information, but reproduced through the Bank of Canada and the Bank of Canada Review, shows that, over time, certainly the largest single source of consumer credit has been the banks. And of course this includes things like home equity loans, which have become increasingly popular. We've also got life insurance loans, a very small part of this overall mix, trust companies, and credit unions. Retail businesses may provide specific types of credit. Sales finance, which used to be a big part of financing of assets like furniture and washing machines and so on, but not very much more recently. And then we've got other sources, including those payday lenders, which have become much more common. Types of loans, well, we've got personal lines of credit, but one of the most important right now, and the fastest growing source, home equity line of credit, or HELOC. We have overdraft protection provided by the bank, which is not intended to be a loan, but maybe a short-term type of loan. Cash advances provided through credit cards. Demand loan, a loan short-term through the bank. And an installment loan. We'll talk about each of those in turn. And you can see from the Department of Consumer Affairs, I think originally, we've got some data that says that 40% of Canadians who hold debt hold mortgage debt. The second category here, HELOC, and the fastest growing one, 13% of Canadians have home equity loans, 28% vehicle loans or leases, 29% use credit cards to carry a balance. Lines of credit, about 20% of Canadians, 11% have student loans, 5% have second mortgages or third mortgages, and 3% have some other type of personal loan. A personal line of credit is something that is offered to creditworthy customers. It's probably often offered automatically as part of a bundle. So if you go into the bank and say, "Hi there, I'd like a checking account," they ask you a few questions about your income and your employment, and they say, "We have the special Royal plan for you or Imperial plan for you," and that will include a line of credit, credit card, debit card, free check, safe deposit box for a low monthly fee of X number of dollars, but we'll waive that fee for the first year. So it's part of a package approach, a bundling approach that the banks like to use. Typically, there are no origination fees with a personal line of credit, which means that it's there for you to use. You can use it whenever you want to. It's there on demand. And it generally has a relatively low rate of interest, which may also be negotiable. That's something else to talk to your banker about. Is there a preferential rate? Variable rate, which means that it does actually change when the base rate goes up. So when the bank announces their base rate, you pay base rate plus 2% or base rate plus 3% for that line of credit. The most recent innovation has been the home equity line of credit. Essentially, the HELOC debt has grown faster in Canada, according to the CMHC, who keeps track of such things, that Canada Mortgage and Housing Corporation. It is now our second largest contributor to household debt after mortgages. About 13% of Canadians have an outstanding balance, and the median amount owed, according to CMHC, is about $30,000. Of course, you don't have to go very far to find information about this. Pretty much everywhere you go, somebody's telling you that if you own a house, you've already been approved. So as long as you've got some kind of equity in your property, there is some amount that you can borrow. If you think about the way that houses have appreciated in value, especially in the last 3 years or so, that means that there's an awful lot of opportunity for individuals to borrow, and for home equity lenders, there is exceptional collateral that is available through those type of loans. Another common type of personal loan is overdraft protection. There'll probably be a limit that's provided, and the limit is probably a soft limit, which means that in some situations you can borrow beyond your overdraft limit. However, overdrafts have two problems. Number one, there's usually a fee that has to be paid if you go into overdraft. So for small overdraft amounts, that can be a significant increase in the overall cost of borrowing. Secondly, the rate of interest that you pay on an overdraft is probably higher than a line of credit. So it's not a good idea to use your overdraft if you can use the line of credit. It's something that you have to plan for, though. So maybe as high in some cases as credit card rates. So something to check before you use them. Credit card cash advances, again, have two types of cost. One, there's a standard fee. So it may be between $2.50 and $10 for a single transaction. And then on top of that, you pay a rate of interest from the minute that you use the cash advance until it's repaid. Now, remember, with a credit card, usually you get a period, 22, 28 days, before you actually have to make a payment, before you actually have to pay interest on that credit card debt. Not so with cash advances. From the minute that you get the cash advance, you are paying that higher rate of interest, and usually it's a couple % more expensive than the usual credit card rate. So definitely something to be very careful about using. A demand loan is essentially an agreement to pay a loan by a certain date with interest, and the interest is due monthly. Because it's a demand loan, it means that the lender can demand that you repay it at any point in time. Typically, the rate of interest is going to be much better than on a credit card or line of credit, but it is still going to be more expensive than the prime rate, than the bank's best rate. Installment loans are loans with a specified monthly or quarterly repayment, mostly monthly for individuals, mostly quarterly for businesses. The interest rate is set in advance, and so you have the advantage of a fixed interest rate if rates are rising. There may be certain requirements for collateral. For example, if we've agreed to use an installment loan to pay for furniture, washing machine, household renovations, and so on, there may actually be some kind of a built-in type of property mortgage or chattel mortgage, and we'll talk about that later. Demand loans essentially means that the loan must be repaid on demand, although banks typically are going to allow you to maintain that loan for just about as long as you need it, unless something really material in your life changes and they become aware of that. Security is a big part of loans. So the word collateral, of course, is like music to bankers. That's not just because bankers are interested in collecting that collateral. In fact, the worst thing that can happen to most bankers is having to what they call realize collateral. First off, when they do repossess something, they can only resell it at a fraction of its value. It also means that essentially the loan has been written off and that the bank has got to provide for that loss in their accounts. So they never want to be in the position of having to admit their mistake in lending. So they don't want to realize the collateral. Essentially, when you borrow, you're assigning to the lender some kind of a claim or a right. It doesn't just have to be for things like houses. We have all kinds of possible collateral. Anything that's essentially durable. And there's many different levels of quality. Something that is solid, fixed, tangible. Something that has a serial number. Something that's easy to sell. A standard type of thing, like a one-year-old car, for example, is exceptional collateral. Something that's unusual, like a work of art, would be very hard to value, and so you need a high percentage of collateral. Financial assets are actually the best thing to use as collateral. So if you have some treasury bills or treasury bonds that you have been sitting on, some kind of guaranteed investment certificates that you don't want to sell to realize for cash, they may be used as some kind of collateral. And they typically are worth something like 90 cents on the dollar for collateral, so they're really good collateral. You can also use things like guarantors or co-signers, and we'll talk a little bit about those as well. Fully secured loans are something that the bank really likes, because that means that they can make the smallest amount of provision of their own capital. So when they report to the regulators, they can say, our loans are fully secured. That means that they can lend perhaps 90% of the deposits on hand that they have on hand to fully secured loans and make a very small provision for possible losses. This is seldom the case when we're talking about consumer loans. Security is neither going to be very good. And if you do have security, it's going to be mostly of the moral type. In other words, you don't ever expect to realize it. You say, yes, we can repossess this, but in the real world, it's almost impossible to do that. Partly secured loans are loans where the borrowers are mostly going to be providing for repayment through the cash flow. You know that you're never going to realize or sell that asset. So something like a car, the best security for a car loan is not the actual repossession of the car, but it's the ability to collect payment from the individual's income, from their cash flow. Unsecured loans or signature loans basically assumes that the lender is unsecured. You're only borrowing against the credit of the individual. You have to have really good credit in order to do this. If you have relatively high risk, you're not likely to be able to get that kind of a loan. So, unconditional promise to repay the loan. Some of the type of security used, other than being able to use some kind of asset, are things like co-signers and assignment of wages. Of course, financial assets are fantastic, and having durable assets like property or movable assets like vehicles, things like that can be used as collateral. Some of the things are clearly unsecured or very poorly secured. A co-signer is something that may be used if you personally have poor credit, but you have access to your parents' credit or a relative's credit or a friend's credit. Typically that means bringing the co-signer into the bank to actually sign in front of the loans officer, and the loans officer will have to question the individual to make sure that they realize the full amount of the liability that they're incurring. Co-signing a loan essentially means that you are promising to make good if the individual can't. And if the individual has poor credit, the chances are pretty good the bank will go after the co-signer before they go after the borrower. It's easier to collect money from them than it is from the borrower if the borrower has poor credit. So you have a formal agreement that's been signed. So you can see in this example, this promissory note is essentially where the co-signer, somebody called Gilles Dubois, is signing for somebody called Peter Dubois. Whoops. Then there's assignment of future wages. Essentially, this skips the stage where a borrower has to go to court, make a claim against you, apply for garnishment of salary in order to get payment. In this case, you've already assigned your salary, so this means that the bank will be able to use part of your salary. Not all of it. They have to make a provision for you being able to live. But it's an agreement that allows part of your wages to be paid directly by your employer. So in this particular case, you can see that a credit union says has not garnished, but has got an assignment of wages that means that your employer will provide from your regular pay a certain amount per week, per month, according to that agreement. Financial assets, as I mentioned earlier, are great collateral, although there's going to be a restriction. Some assets can easily be converted to cash, things like bonds, stocks, life insurance, GICs, Canada Savings Bonds. However, anything that's in a retired plan, like an RRSP and RESP, can't be used as collateral. So even if you have $1 million in your RRSP, it may actually be a source of repayment in the most dire of circumstances, but it's not something that the banks consider to be collateral. For formal assignment of those assets, you'd have to fill in a form like this, a security agreement, which means that even though you still hold on to the bonds or the stocks, they have got a claim against them, so you agree not to sell those without their permission. So you have to actually specify the particular financial instruments. Durable assets include basically anything that's tangible and has a long-lived value. Cars, furniture, well, probably never furniture, but that's what they say, a stamp collection, anything that's a good store of value. And essentially what we're doing is we're entering into a mortgage agreement, but in this case our asset is movable. A house, not movable. A trailer, yeah, it's got wheels, it can move. A mobile home is movable if you leave the wheels on, and if you take the wheels off, it's an immovable. Interesting point in law. A chattel mortgage is a mortgage agreement for anything that's movable. So something like your car, your appliances, furniture, vehicles, any movable object like land or buildings. Well, for that you would use a regular mortgage. You still maintain full use of the asset, but technically, to a degree, that is the property of the bank until the agreement has been concluded. So until you repay the chattel mortgage, technically you're driving the bank's car. Part of the agreement is that you are responsible for maintaining the asset in good conditions, maintaining insurance to a certain level. You don't have the right to sell the item without the lender's permission. And in some cases, you'll see that on title, where there is some kind of a title registry, the lender will have their name so that you can't sell it with clear title unless the lender signs off. If you default on the loan, the lender can repossess the asset and you're still responsible for the remainder. A lien is essentially a legal claim against a property. So land title offices maintain a registry of liens against fixed property. There's a mechanics repair lien that can be applied not just against vehicles, but against just about anything. So if you're getting a project built by a general contractor, they may require a lien against the property to ensure that they get paid. So the property can't actually be transferred as long as you owe the contractor money. So in any case where we have got an obligation, we can create a lien that's going to be used to guarantee collateral in case of repayment. Another Another type of borrowing, which was more common before we had things like Visa cards to pay for assets, was a conditional sales contract. A retailer would agree to sell you furniture, washing machine, or a television, and you would sign a piece of paper that would be transferable, essentially a promissory note that would say that you agree to pay in so many installments over so many months for this particular asset. And if you don't pay, you miss 3 payments, then that asset reverts back to the borrower. Organizations, stores like, if you went into the Brick, they would say, well, we can get you this furniture. Oh, don't worry about paying for it. We'll give you 60 months to pay, no interest. And you would sign that note. You'd make the payments. But from the date on which you bought the product, the Brick or whoever the retailer was, would sell the agreement to a financial institution. At one time, almost all the financial institutions were American banks that were funding those promissory notes that were issued by retailers in Canadian stores. So the loan would still be serviced by the bank. They would still collect the money, but as far as you know, the agreement would be with that furniture store. And so this is what a conditional sales contract would look like. This is probably only the first page of many pages. It essentially says who the vendor is, who the buyer is, what the total amount of obligation that was created. In this case, looks like $5,016 is the total amount of the contract, and that you're going to pay over 24 months at $209 a month. And of course, then all comes the legalese on the next few pages that tells you what the full amount of your obligation is. Less common now because, of course, we have credit cards. And credit cards have largely replaced a lot of that business. We're still entering into the same kind of an agreement, but we're dealing directly with the bank. We have a couple of different variations. Still very common, but not as common as they used to be. We have charge cards, the retail organization cards that allow you to buy with an agreement that you'll actually make the full monthly payment before the due date. Credit cards expect that you will in some cases carry a balance, so they're offering you credit and not just the transaction service. Charge cards were all about the transaction. So if you went into a store, they say, would you like our store card? We'll give you 15% off today's purchase if you get our card. Obviously, sounded like a great deal if the purchase was big enough, but now you've got a credit card or a charge card that you may only use a few times a year. The difference between a charge card and a credit card is that a charge card usually requires that you repay in full by the end of the period. Used to be that most oil companies, most gas stations had their own credit cards. But we also had we still have American Express and Diners Club, which have operated traditionally as charge cards, although American Express does now also have a credit card version of their charge card. So American Express, if you used it to buy some goods, you were supposed to pay by the end of the month, and a very substantial amount of interest became due if you didn't. So you were already into arrears by the end of the month. Credit cards are much more like a line of credit in that they only require a minimum payment and that a balance can be carried over a very long period of time. So you can continue charging purchases as long as you pay a portion of the bill each month. And that's the important distinction there. So Visa versus American Express, charge card versus credit card. We have a lot of different kind of issuers of credit card. Now, most universities actually have got some kind of a credit card that has their name on it. So regularly from about 2 or 3 universities, I get some kind of promotion saying, support your university, get a University of XXX credit card, and it has a picture of the university on it. It's got their logo. They have absolutely nothing to do with that credit card. It's issued by an organization, typically an American bank. One of the biggest card issuers, the biggest card issuer in the world is an organization called MBNA Bank. And so World Wildlife Fund or Greenpeace or National Rifle Association, University of Victoria, whatever the organization is, they will lend their name to MBNA. MBNA will provide a kickback to the organization of 1 or 2%. And those cards are called affinity cards. So, still issued by a bank technically, and they have a Canadian bank license. So they're operating in Canada legally. But they issue credit cards on behalf of just about everybody. Sports teams and Formula One, everybody's got their credit card. Retailers, of course, also offer credit cards, and they enter into arrangements. So Costco has got an arrangement now, I think, with CIBC. So you can have a Costco card, but it's a CIBC Costco card. In fact, very few of the banks operate their own merchant and card services. They usually contract that out through somebody else. But 95% of Canadians have one credit card. That sounds pretty obvious. In fact, I remember when my son was in elementary school, getting him a credit card just in case. It was entirely backed by my credit, but I felt it was kind of important that if he did need to get a cab or something like that, that he had a way of doing that. We have about 76 million. Of course, this comes from the Canadian Bankers Association. They say about 76 million Visa and MasterCard cards are in circulation in Canada. There are at least 30 low-rate cards. And by that I mean classic cards, classic Visa, classic MasterCard, that have relatively low interest rates and are often offered to people who would not otherwise be able to get access to credit cards. The cheap version of the credit cards. No special insurance policies, no car insurance for rentals bundled in, no special rewards or other features, basic plain vanilla credit cards, and only charging about 12 or 13%. Canadians really like rewards cards, so about 72% of Canadians have a rewards card plan, and about 82% say rewards are a priority when selecting a credit card, a discussion that we actually had in class earlier. How many credit cards do we have? Well, the dark blue boxes represent debit cards. About 70% of Canadians have one debit card. Another 25% have two or more. And another 6% have more than three debit cards. Credit cards, about a third of Canadians have one, a third of Canadians have two. Many people have more than four. And we had this discussion in class. You can see that there is a good reason for carrying more than one, in case there is, for some reason, your credit card it disappears or it is stolen, and you have the card locked. You still have the other credit card to use as a backup. Some people will have special credit cards that they use for different reward programs. You have to remember that whatever the balance that you carry on your credit card is the amount that shows up on your credit rating. So if you get a credit card for an amount that's more than you need, you might want to think about reducing the balance, the available balance on that credit card, or just getting rid of that credit card. You're using up your borrowing capacity if you've got a credit card that you don't actually use the balance for. An important bit of information that most people would probably miss out on. Two different types of credit card users. Some people have a credit card to borrow. Most people, in fact about 70% of people, pay their credit card balance every month. So those people are convenience users. They use them to keep track of their expenses. They use them to collect rewards, but they pay every month. About 30% of Canadians carry a balance from month to month. So that makes them borrowers. They're the other type. I mentioned some of the features that are available on credit cards. The affinity cards that support your sports team or your university. I don't know if VAU has one, but we better check into that and get one right away. Points cards that provide some kind of cash refund or extra points that can be collected for airline miles or to buy a car. And even those car cards that are issued by some of the biggest non-bank financial institutions, the car finance companies like General Motors and Ford, Ally, and so on. Yeah, and according to the Canadian Bankers Association, more than 600 different Visa cards. An average rate, I have to double check that number, 18%, but many cards are over 20% at a time where we've got a risk-free rate of 1.5%. That's quite a spread, which the banks will explain is basically the cost of certain extra features like insurance products that are bundled in. Credit cards are more expensive to administer than loans, but they come with a free borrowing period, 28 to as long as 51 days before payment is due. And so if you're a convenience user, you're getting free credit for up to 51 days, more likely 28 days. And for the banks, it's unsecured lending because there is no real collateral. The typical free period is 28 days with no interest. And if we are using one of those extra feature cards, they include things like car insurance. So when they ask you if you want the extra insurance when you get to the car rental place, you can say, no thank you, I've got my credit card. Read your statement, make sure you're covered, but there may also be travel insurance that is included as well, provided that the things like the hotels or the airfares were booked on that particular credit card. So you can't use your classic card to book the airline, to book the airfare, and then your rewards card to claim the insurance. It doesn't work that way. Some of the main reasons why Canadians use a credit card, accounting purposes. I know when I look at my credit card statement, it tells me how much I spent in restaurants last month, how much I spent on groceries, on fuel, on retail purchases, on clothes. In some cases, it's way too specific. It helps me to take account of my expenses, and it'll also provide an accumulated year-to-date amount of those expenditures. Of course, as we discussed earlier, and I think Prem mentioned in particular, he loves those reward points. So reward points, access to airline lounges and things like that might be part of that. And about 30% of Canadians say that's why they use a credit card. Online purchases, and of course we're not even talking about things like PayPal here and other types of online payment methods. But this provides a great advantage at a time after COVID where people are still buying an awful lot of stuff online. The one thing that we'd be concerned about is that people are using credit cards because they're short of money. They're using them like payday loans, and clearly they're cheaper than payday loans, but still a very expensive way to borrow. In fact, if you take a look at the different types of borrowers that we have, and again, from the Canadian government and the agency that monitors consumer spending, we can see that if people are careful budgeters, most of the reason why they use credit cards is for accounting purposes. Part of it is rewards, part of it is going to be online purchases, and it's only a rare event that they use credit cards to be able to cover their debts when they can't otherwise. People who don't budget and say that they don't budget because they're overwhelmed, it's too much trouble to budget, they're the ones that largely end up borrowing in order to cover their debts. And people who are not budgeting because their income is so steady and so specific, they're the most likely ones to use it for accounting purposes. So people like pensioners, people on fixed income, are most likely to use credit cards to keep track of their purchases, to collect reward points, and also relatively unlikely to use them because they're short of money. Credit regulators, credit regulation is provided through a number of different acts, both at federal and provincial level. Certain types of lending activities are federally regulated, some are provincially regulated. And we'll talk a little bit about the regulators in a couple of minutes. But among those regulations, the first thing is, the most important thing, full disclosure. So the fee and interest costs have to be accounted for, have to be disclosed at the beginning. Any special payments or requirements also have to be disclosed. And in some cases, especially provincially mandated, cooling off periods allow you to back out of a contract, especially if you signed the contract at your home. If somebody comes into your house and says, we want to sell you some windows, and you think that sounds like a great idea, and the interest rate that they're offering me is fantastic, and I love these features, and then somebody says, you didn't fall for that, did you? And it tells you why it was a really dumb idea to go enter into that contract, or at least suggests that you get a second quote. You can phone up and say, hi there, I've had some second thoughts, I'd like to cancel the agreement. They'll probably give you 10 good reasons why you shouldn't over the phone, but still you say, right, I want a little bit of time to think about it, I'll get back to you. You can do that because of the cooling off periods. There is also, in some cases, a cooling off period allowed for contracts that are signed in a place of business, but it's much more generous in terms of cooling off allowed at home. And if goods are offered to you or provided to you without you actually asking for them, in cases like that, typically you can get out of those kind of contracts. So now fewer of those type of contracts are offered. We don't get into the full details of that, but you'll see that I've provided a couple of links in VIU Learn to a couple of great sources for consumer credit protection. The last major topic in today's session talks about identity theft. Now, reminder, I don't cover everything that is in Chapter 6 of the Madura-Gill text. We go into a little bit more detail on the things that we do cover. So for things like car loans, take a look there. I did think that identity theft was something that was worth talking about. And I'm not an expert in this, but I do find it an interesting subject. There are a number of interesting standard methods that we hear discussed. Things like shoulder surfing, where people basically are standing very close to you, listening for information, perhaps about your credit card number if you're reading it out over a phone, or other personal information that can be used for other types of identity theft. That's closely aligned with dumpster diving. Actually, it's completely legal for somebody to go through your garbage, because once you've thrown it away, you have typically no expectation of privacy. That's a great argument for shredding or burning or otherwise safely disposing of anything that's got personal information, any kind of personal information. And some people are very careful about religiously shredding absolutely everything at least twice. Dumpster diving essentially means people going into your garbage and finding things like old credit card statements, telephone bills, any kind of documents that you really need to get rid of carefully. Then we get to some of the more elaborate versions of identity theft. Skimming essentially involves using electronic measures to gather information. I don't know if you carry around an RFID protected wallet. If you've got a special lining in your wallet that stops somebody from walking next to you and actually stealing information about your identity from your credit cards that happen to be in your wallet, that's one type of skimming. We've seen other versions of this, including point-of-sale machines, which may look like real point-of-sale machines, but are not actually genuine ones. I know I looked at this particular image that I saw on the internet, and until I read the article, I couldn't actually see the difference between a real point-of-sale machine and a fake one. For parking, for example, you could put up a whole separate kiosk. People would come and tap to pay for their parking, and then only later discovered that somebody just stolen their credit card information and was using it to make online purchases in 20 different locations around the world using your credit card information. So yeah, in this case, you can see there's some measurement indicators that say these ones are a little bit different than the ones that we actually use. Sometimes skimming actually happens at a point of sale where a salesperson brings in their own separate pad, which they'll scan your card once on their pad, and then they will make a show of rubbing the card, and then they'll scan it on a second machine and essentially be stealing your credit card information right in the store. So make sure that people are only scanning your card once. A second one that I had only heard of just recently is where there's a separate mechanical insert that's put inside of something like an ATM machine slot, or stuck onto the face of an ATM machine slot, which means that when you scan your card, it's actually being properly scanned by the bank machine and also scanned by the shim, the insert that's been put into the card. And when I Googled this, I actually found a place to buy them online. So if I ever do want to buy a shim, they're available for sale. Several different places. Pretexting is essentially a description of using social engineering, trying to gather information in order to be able to con somebody. You can get a lot of information about people from their Facebook information, from their LinkedIn, from a variety of different social media sources, and that'll provide you with half the information about the people's life that you need in order to do the identity theft. Sometimes you'll get an email from somebody saying, hi there, I'm a friend of a friend from this club, and I understand that you're going to be in Europe next week. Can you can you give me a little bit more information about where you're going to be, because it might be nice to meet for a coffee. And in the process, you might eventually give them enough information to be able to do identity theft. So that's described as pretext or pretexting. A couple of other ones we've all had some experience with one way or another. Those famous emails from a prince in Nigeria, or perhaps a great niece who's traveling in South America who has a medical problem and needs you to wire some money. And of course that's phishing, and it's usually highly directed. In other words, they know enough about you to be able to effectively con you. Some of the cons are just laughably so silly that you wonder how they catch anybody, but they go at the number games. And as compared to phishing, this is called farming, where phishing is happening at a wholesale level. So thousands of messages are being sent out saying, please click this link if you can help. And of course, clicking the link is going to be the first step to being conned out of some money or having identity information stolen. And so that's described as farming. We really can't give you the whole story in this even 1 hour long video, very long YouTube video for us. We haven't covered all the material, so please do take a look through the material in Chapter 6 of the Madura and Gill textbook. Also check out the Financial Consumer Agency of Canada website. This is one link that's provided either by clicking on this link or go to their website by Googling FCAC, or Financial Consumer Agency of Canada. I hope this has been valuable, and I look forward to talking a little bit more about this in our next couple sessions, both in person on Zoom and through our next video session. Thanks a lot. Have a great day.